We're all tuned in to how interest rates are rising. Mortgage rates that were under 3% a few months ago are now well over 5%. But what do these rising rates mean for your life insurance policy? If you own a general account permanent policy, such as a whole life or universal life contract, you'll have likely seen your policy impacted by some or all of the last 20 plus years of declining interest rates. In a whole life policy, this means that dividend rates have fallen from somewhere around 8.5% to 4.5%. And if you own a universal life contract, you may have experienced seeing your crediting rate drop from over 7% to either your policy's guaranteed minimum rate or even lower, maybe around 2% or less. You are undoubtedly asking yourself, when will I see the rates for my policy go up? First part of seeing your policy dividend or crediting rates go up is to understand that the insurance company needs to do better before the policyholder does. This means that an insurer needs to see improvements in the investments backing its policies before it can lift policy rates. Now, I often remind folks that this worked in reverse in favor of the policyholder when interest rates were falling. Because insurance companies' portfolios had been invested at higher rates, it took time for falling interest rates to drag on that performance. As a result, the eventual decline in dividend and crediting rates came slowly. Now, we can expect this to happen as interest rates rise. Policy dividend and crediting rates will follow slowly, possibly with a lag of 2 years or more before meaningful changes occur. And remember, this is because, especially over the last decade, insurance companies have had to make their investments in a low interest rate environment, so their portfolios will need time to benefit from rising rates before passing those on to policyholders. What we tell our clients to look out for is if they have universal life policies. Now, this may or may not be the case, but it could be that an insurance company might move on from that particular product. They might start issuing a new universal life contract at a higher crediting rate so they can immediately take advantage of the new higher interest rates for that portfolio. Now, if this happens to you and you felt you've been left behind in an older universal life contract, you can consider making a tax-free exchange into a new product. Now, unfortunately, this could also mean new underwriting, and if your health isn't good, other options may need to be explored. If we can help you explore your options as interest rates rise, reach out to us at lifeinsurancestrategiesgroup.com.